In this video, traders, we're going to look at the dead cat bounce gap trade. What for you day traders who like to trade earnings or surprise announcements? Stay tuned. Hey guys, warm welcome to you. So earnings season, depending on when you're watching this, it's going to come at some point, and there's normally a lot of spice in the markets during earnings season, which can bring a decent amount of opportunity. All right, so I want to talk specifically today in this video about the dead cat bounce gap trade. If you're subscribed to the channel, your support is appreciated. If you like this video and you're not a subscriber, maybe at the end of the video, I can earn your subscription. Okay, let's get on with it. So dead cat bounce gap trade. This works in any market really, but specifically equities when you have some kind of announcement overnight when the market is closed, or you've got the pre or post market trade, which is less liquid and less volume, and that's going to change the value fundamentally of that company. And that could be, hey, our earnings are really, really good. Hey, our earnings are really, really bad. Hey, we've won a court case, lost the court case, exec has left, hired somebody. You get the point. So with this example here, let's start to draw this stuff on. So stock here, XYZ, let's call it. We always use that, don't we? Just come at something a bit more interesting. XYZ closes at that point. That's yesterday's close, and we put Y close there. The next day, for whatever reason, it gaps down. Now, this is what we're talking about, the dead cat bounce. Dead cat bounce, I'll explain what it is in a second, but it is only for stocks that have gapped lower. So let's say it opens down here. It's minus 7%. Okay, pretty bad news, not catastrophic, but pretty bad. So what happens? The market opens and it starts to push lower for the first kind of 30 minutes or so. So that's your first criteria. You want 30 minutes, and it moves lower in the first 30 minutes. Right, that's just setting the scene, because often how you can get caught out with this is that it rallies immediately off the open, in which case you need to just forget it and change the way you look at it. There are other setups and strategies for that. I've kind of covered some of those before, but specifically this is what needed for this setup to occur. Right, so you're going to drive lower. 30 minutes, then we get the initial dead cat bounce, okay? And this is, I call it a dead cat bounce, God knows why they call it that, but you know, because dead cats bounce, but they're still dead. That's really the thing for it. I don't know who comes up with this kind of names, but anyway. So we now get the cat is bouncing, and it's dead, but it's bouncing. Now, we are looking to go short at some point on this. We've got the gap, tick, we've got the move lower, tick. Now we've got the bounce. Now if we kind of zoom in on this and look at it like this, we've got the first 30 minutes lower, then we start to get the bounce up. Now you could get a bounce that comes up and doesn't take out that high. That's preferable, really. I prefer that. So it's coming up, hasn't taken out the high or the open, should I say, wherever it could be the high, could have kind of pushed up a little bit. As long as we've trended down generally the first 30 minutes, doesn't matter if the first kind of 5 does a little bit of a rally, as long as the first 30 is generally down. We push back up. Now at this point here, we're looking for some signal along the way to go short. Now this is a tricky one. This is a tricky one, because you know, you may have to take a stop or two before you get on the end of a thick move, because this can be quite sharp and it can look as if it's a complete reversal. But ultimately, you're still playing with the expectation, you're still trading with the expectation this is going to curl down and continue lower at some point. So you're looking for a reversal. Now, that could be a double top. That could be some kind of wick to the upside, you know, some kind of candlestick pattern that you've got this. It could be, you know, a heavy red candle after that. You know the kind of thing that you're looking for, some kind of price action. If you're an indicator guy or girl, then maybe something like overbought on an RSI, or whatever tool you need, upper Bollinger Band tag, however you want to frame it. This is up to you. This is kind of the fundamental foundations of the trade. How you're timing it is entirely within the strategies or the sphere of strategies you use. For me, it's always going to be price action. I'm looking for some kind of signal in those candlesticks there on a lower time frame that this thing's rolling over. Right, so when we get that signal, then we're looking to go short. So we're selling it short here, sell short, and we're looking to push much lower. So this is a decent risk reward trade. This is why you can accept a couple of stop outs, because the risk reward ratio is going to be 5R plus. It's got to be that because of the nature of it. Because you can time your stop, and let's say you're doing this kind of price action trade here and you're going short around here, your stop's going to be above the high. Let's say that is, I don't know, 50 cents, say if it's on a stock, then you've got the possibility there for a $2.50 move plus. And that's what you should be looking for in it. Now, one quick caveat, guys, is that this thing can quite often take out the high. If it does, that's fine. The key to not getting completely hammered on this trade is to not step in front of that without any reason. So you have to have all these parameters, all these filters, but you must have a trigger. You must be very strict with the trigger. And whether it's a price action, whether it's an indicator, whether it's a kind of a moving average crossing over back again, whether it's going from overbought on an RSI back into a neutral territory, something like that, you must have that trigger, because to step in front of this is deadly. Believe me, I've stepped in front of a few on the wrong end of it several times. So you've got to make sure you have that turning and have a very strict stop loss on it. However, let's go back to the point. If it goes above that opening level or the high of that move, it's still valid. Okay, it's still valid, but you've got to be a little bit more cautious. Okay, you want it to fail pretty quickly above here. You don't want it going all the way up here, because even though there may well be a down move, and I'm pretty sure there will be at some point, because the trend has kind of changed, that may well be a down move ready for a gap fill. That's a gap fill type trade. We don't want that. We want it to fail above that high. If it happens to fail above that high and rolls over, then to me that's still a good trade, because, you know, fundamentally we're still down on the bigger picture. This has kind of tested the high. No real buyers have got sucked in thinking it's going to be a gap fill, and it's pushed lower. I would be targeting, you know, multiple moves below the low and almost doing a measured move and extrapolating that distance from the rally to the downside. So saying, what's that to there? Okay, that's X. Then I'm expecting, you know, kind of at least X to the downside underneath that low as an extension. Anyway, that's the dead cat bounce gap trade, guys. There's little rooms to maneuver and play around with that and fiddle with it and adjust it to suit your style and strategy. But ultimately, this was a pattern that does repeat itself continually, especially during earnings season. That gap lower, that push down, the potential fake drive that sucks a few people in. Then we have that bigger, higher time frame money just pressing down on it. That's what we're jumping on. As soon as we spot that signal, jumping on it, stop above a decent level. Listen, you know, we're not always going to get a stop above the high. It's great for me to stand there and go, yeah, let's go short on there and have a stop above the high. I get it. We're not always going to see that nice little beautiful signal, but we might see it further down in the move here. It's still quite valid. The point is wait for the trigger. It might be something like a heavy drive, you know, and just flagging down there, aggressive selling, in which case, you know, waiting for the flag to sell short on the flag and a stop above there. That's fine. You know, I'm just giving you examples that would be nice if we saw it right at the top, and often we do see that. That's how they reverse, and we see those wicks and etc. But if we don't and it just rolls over, don't just jump on it. Still wait to see that something or other there that's going to help you out. It could even be support, you know, some sort of support that's been resistance and now turning support on the way up, broken down, holding below, that kind of stuff. Anyway, guys, dead cat bounce gap trade. If you like this kind of stuff, thumbs up is appreciated, as is your subscription if you haven't yet subscribed. Take care. See you in the next one. Bye bye.